Indian holders of derivatives, which as we know are financial contracts whose values are dependent on underlying assets, the holders of those derivatives have been losing tons of money. Why? Here's ET's Markets Ace, my colleague and co-host, Nikhil Agarwal.
In 2023, SEBI did a study saying that 9 out of 10 option traders in India are losing money, and we're talking about retail option traders, right? So the average loss was around 1.1 lakh, according to the study. In the last 1 year in particular, we have seen a lot of traders coming out openly saying that they are actually not making money anymore. Many of them, we have heard many cases, not only frauds related to stock market, but also genuine people, genuine traders who are trading full-time, who are trading part-time. The number of people who are saying that they have made losses has increased tremendously in the last 1 year. Even people who made a lot of money in the previous cycle, which was during COVID.
Now, all of this has a somewhat lateral and very curious relationship with Wall Street-based hedge fund behemoth Jane Street Group and the group's lawsuits against its two employees and rival Millennium Management Global Investment.
So what is Jane Street? Jane Street is a US hedge fund, and since they filed a case in a US court, so we got to know that they made a profit of $1 billion only on Indian options. Now just imagine $1 billion, which is about 8,300 crore in Indian currency. And that is only one hedge fund which made so much of money only by trading in options. Now see, how does it look like? Last year we had a report which said 9 out of 10 option traders in India are losing money. And now we have another report which says one hedge fund in the US made $1 billion in the last 1 year. Now, this contrasting picture is very interesting. Whom are we fighting against? Whom are the retail investors or retail traders fighting against? It's a fight of fingers against machines or HFTs, Algos. So small traders are losing money on one hand, and on the other hand, the big guys are making money.
So, in this episode, we try to find detailed answers to 3 questions. Why are small-town option traders losing money in India? Are the big boys making money at the cost of smaller ones? And how is the daily expiry adding to the problems for small investors? It's Thursday, the 16th of May. From the Economic Times, we are your hosts Anirban Chaudhary and Nikhil Agarwal. This is the Morning Brief. Nikhil first spoke to veteran options trader and trainer Chetan Panchamia.
The starting point for this conversation happened because of the Jane Street versus Millennium issue, which you know about, right? So why do you think that retail Indian option traders are making losses, but on the other hand, US hedge funds are making tons of money?
Okay, Nikhil, you need to understand first a brief history. Before COVID 2020 March, Indian retail was basically into option buying, and HNI and FIIs were into option selling. Post-COVID, when people were sitting in the home, they started learning about the benefits of option selling, and the high wicks actually helped them make a lot of money. And there was a very good period from March 2020 to say October 2022. Post-2022 October, the situation changed. The wicks collapsed below 16. And that is where option writing became very difficult. Now comes that hedge fund picture. So these hedge funds, who are they? You have to understand, you told me about Jane Street. So let me give you a brief. These guys have offices in about 8 or 9 major cities in the world. Employ about 2,000 people. And you know, what was their profit last year? $7.2 billion. So you'll be shocked. In 2,000 people, if this person is making $7.2 billion, it's phenomenal. In what I understand, they are trading about 5% of the total ETF volumes, 9% of the total bond volumes, somewhat staggering amount. How are they able to do this? So they are market makers. They get in and get out. They provide liquidity. Number 2, they are high frequency traders who have designed algos, which are not static. which take the market conditions and they initiate the trade. So this is all done by the algo, and they're far, far superior in execution. So when it comes to zero DTE and when there is such a huge volume, you are actually fighting with a high frequency trading firm who has a very big edge in terms of technology, in terms of superior brains which are designing these algos, and the variables, inputs which they have designed. They are not static, they are ever changing. So you are in a losing world.
You just spoke about zero DTE. Can you please explain this concept and tell us
Yeah,
what is an expiry date trading and whether expiry date trading is also adding to a problem?
absolutely. So zero T DTE is the exchange have facilitated an expiry for a product every day. So Monday, you're probably having a mid cap nifty. Tuesday, you're having a fin nifty. So which is an expiry on that day. So when you're taking a trade on that expiry day, that means it's 0 days to expiry. Now, earlier, because of these backtesting models which were there, they showed that there was a huge advantage for an option seller when he trade at 0 DTE. But there are few caveats. The caveats are that seemingly easy entry and seemingly easy exits. So that backtesting model doesn't tell you about the slippage. So what is a slippage, Nikhil? Slippage is the price you pay above your selling price when either you are exiting in a profit or when your stop loss gets triggered. So what has happened is there's an imperfection here, Nikhil. NSE follows limit price protection mechanism, where if an option average of the last 30 seconds, if the price is above 50 rupees, and in a single minute, if it goes up 40% of that average, all orders in the system will get cancelled. All the option trade orders in that system for that particular strike will get cancelled. Now, this is where the complexity comes in, Nikhil. Because of this algo trading, it's very easy for an individual now to manage a very big portfolio in option writing. So what has happened? This has become a very crowded trade because of the low VIX environment. Everybody wants to trade in the zero DTE as an algo, which is a time-based straddle, re-entry, re-execution, which are static inputs. And this is where these hedge funds, they come into the picture. They design anti-algos, where they know that if there is a certain movement of that option price, these many stop losses will be there in the system or will come there to get triggered. And that herd mentality of cutting and triggering the trades brings in that panic and it eliminates your profits. So it's just the start, Nikhil. And believe me, as time goes by, those people who don't change this, who are trading on the stop loss based models in writing options on the expiry day, they're going to lose a very big amount.
Can you also help us understand why is options trading called as a zero sum game?
So, Nikhil, we talked about two players, option buyers and option sellers. So, what you've heard, Nikhil, of late, there were a lot of spikes in, those people who had sold, say, a 20, 30 rupees option. Because of the spike, the stop loss orders got cancelled and they were forced to cut at 200, 300 rupees. So the sellers were the ones who were losing money on that particular trade. Now, on the other hand, the other counterparty, the buyer, who had bought, say, at 15, 20, 25, within a minute, he got 200 to 300 rupees. So the loss technically given by the seller will be technically the profits made by the buyer. So it becomes a zero-sum game. So now who makes money? Say, the guy who has, in that high-frequency environment, a better technology, a better brain power, who can visualize the different market movements which can happen and plan the trades accordingly. And in zero DTE, I believe now without the algos, it will be very difficult for an individual trader to put in big money.
Are you trying to say that it is like nearly impossible for a small options traders to fight
Good.
against a multi-billion-dollar US hedge fund?
So, Nikhil bhai, there is a saying in Chinese, if you can't fight them, join them. So there is another saying, Nikhil bhai, which I want to give you to you. don't go to that area where you are bound to lose.
Mm.
So my suggestion is, if you're a small time option trader, avoid or don't go to zero DTE. And if you are going there also, put your positions with adequate hedges and try to be a positional trader instead of using stop loss based trades. So if you are using stop losses, make sure when you are coming down to zero DTE, you should have proper hedges in place early in the morning. So that is the funda. Don't trade against them. So because they will hit you when you are least expecting it. So Nikhil bhai, just a 100-point spike can take down your premiums from 34 rupees to 230. So it tells you what will happen if there is a reality, there is a problem, and Nifty or Bank Nifty fall or rise by 200, 300 point on an expiry day. That day, lot of trades will get squared off at very big losses.
One more thing I wanted to ask you is the fact that in recent weeks we have seen very sharp and sudden abrupt spike in option premiums. Why is it happening? Can you explain to me in very simple terms?
Very simple, Nikhil bhai. Nikhil bhai, if 10 people are in a room and there is a fire and there is one gate, what's going to happen? Right? People are going to jostle with each other to get out.
Right.
Same thing, Nikhil bhai, here is when too many people are in a similar trades and having a similar exits, stop loss based exits. And when that fire starts and when the stop loss starts triggering, there is a chain effect. When it's squaring off, the other one is squaring off, and there's a huge portion which gets squared off. And because of this chain effect, what do you see? You see a spike in option premiums.
Do you also think that these big HFT guys, the big dollar money, may also be trying to sort of, if I can say, game the system?
Nikhil bhai, that's always been the case on the expiry day. It's nothing new. See, there's always a fight between two parties, the sellers and the buyers. So the sellers will always try to bring the price to such a point where the buyer has the maximum loss. And the buyers will also try their level best to take that to that point where the sellers can have the maximum loss. This is a game. And in this particular game, whoever has the superior technology, superior edge in terms of algos, better understanding of the current market conditions, they are the ones who are going to make money.
Next, we went to Rahul Sharma, Head of Technical and Derivatives Research at JM Financial Service.
So options trading began as a tool to hedge large portfolios, but retail traders see it as a get rich fast tool. Don't you think that options is actually the toughest way to make money in the stock market?
Yeah, that's a good one. So you have the smartest minds on the planet fighting it out in real time to literally take money out of your pocket. As we all know, derivatives is a zero sum game. So there is a definite loser for every winner that you have. And eventually, money is just transferred from one pocket to another. What is actually happening is earlier, when the market was not so developed at a nascent stage, there were market makers and then there were traders and speculators who would sort of take advantage of the intraday movements. But now, with the advent of algos, with the advent of huge participation that we've seen across FIs, across retail, that has brought in a lot of this robotic trades as well into the system. Now, there are softwares just waiting to skim out any pricing irregularity that may exist even for a split second to make a risk free profit from these trades. It's literally like thousands of years old brain fighting it out with the algos who are much faster, much quicker. And mostly these algos are with the prop guys, with the institutional teams. And probably that is the reason why we're seeing this shift where they are dominating this market in spite of the huge inflow of retail coming in. So money making definitely is not easy when it comes to options. But the lure of making easy money is what brings a lot of retail participation over here. The ticket size is very small. For example, if somebody has to buy a certain stock in cash, he has to put in the entire money. If he has to buy even one lot of, say, a future of any stock, he still has to have 1.5, 2 lakhs as margin to create that position. But if somebody has as little as 5,000 or 10,000 rupees, they can very much speculate using index options and actually on good days have a profit as well in a day. So on a 10,000 capital, making 2,000 rupees in a day is a very, very likely possibility. But what happens is people get into the lure of making that quick buck. But then once you have that volatile period, like for example, April was a pretty trending month. This month we are having a lot of choppiness in the market. That is exactly where a lot of these momentum traders are sort of losing money when it comes to a non-directional market like this. So yes, money making is not easy, but at the same time, I would say the other way around as well. That if you get it right, you can make a lot of money in a very short span of time, given the kind of asymmetrical payoff that these options provide.
Any guess that you would like to make as to how many retail traders are actually making money?
I know that number is a very, very small one. At the same time, I think the better question to ask would be out of these, in terms of quantum, the kind of money that the retail is losing. So, yes, we have a very, very big retail market, but the ticket size of these customers, these clients are also on the lower side as well. Having said that, you cannot take away from the fact that it's the majority which is apparently managing to lose money in derivatives. So it's something which is shared by SEBI as well. A few months back, we had a report where they had shared like majority of these participants in the retail side are losing money in the derivatives, and in spite of that, the market just the volumes and the participation just keeps on booming. So you can also sort of credit this risk appetite to the bull market that we've had. So the smarter traders have actually increased their positions, increased their trades based on the kind of profits that they've made. Had it been a bear market, I think the story would have been entirely different. The volumes, the expansion wouldn't have been so big. And we also have to keep in mind that literally we have every day is an expiry day. Earlier, when I started my career, it was just one last Thursday of the month was when the expiry was, and we would actually sort of look up for that expiry day so that the entire positioning, the entire strategy was devised based on how to end that Thursday on a profitable note. And if we did that, we would have a party the following day on Friday. But now, literally, every day is Halo India, Halo kind of a setup where exchanges are looking for more and more market share and retail is looking for more and more trading opportunities in the same.
Also, can you elaborate a little more on why is daily expiry such a big problem? I think the losses got aggravated as soon as Sensex derivatives started picking up around 6 to 7 months ago.
Yeah, so what happens with an expiry is the option that you're betting on has to expire in the money. If it expires in the money, and if you are a long option trader, you would make money on that bet. So it is as simple as whether Virat Kohli will score a century or not. If the answer is yes, you make money on the bet. If the answer is no, you don't make money on the bet. So because of the daily expiry, the rate at which these options become worthless, and as it is there in statistics, more than 80% of the options expire worthless on the expiry day. So, not these options which are traded turn out to be zero eventually on expiry. And there is a theta curve to it. So, the rate at which the premiums erode along with the passage of time is the maximum on the expiry day. And like earlier, when it was just say one expiry a week, the theta decay was relatively a shallower slope. But now what has happened is because every other day we are having an expiry, the rate at which these options are heading towards is also very, very fast. So this has given birth to this concept of hero or zero. So we've seen so many options go from a few pennies to 100, 200, 300, 400 rupees. I mean, phenomenal returns. And these are the poster boy trades which are shared on social media. And that is what brings in more and more people. So out of say 10 expiries that you would trade, example, you might get a one or two trades where you literally make a killing or a jackpot, and the remaining eight trades you might just end up losing the money. This is exactly what pulls a lot of these speculators into the market on the retail side, where they are looking to make that 10x, 20x kind of a return from these hero or zero trades. And frankly, there is no other asset class where you could literally 10x your money in a day, provided you play it right. So we haven't mastered it. I mean, our team is constantly trying to crack a code to make money on that, but it has been very, very difficult. But if you play enough number of instances, you might end up with two, three, four, depending on number of trades that you take. And these home runs or this big wins, which will be like the poster boy trades. And nobody literally talks about the loss making trades as much as it is the profit making screenshots are shared across. So that also brings in another problem on social media, which is We are only sharing the wins. What about the losses? And we try to educate clients that don't just look at the winning part, there's also the losing part to it. So always manage your risk well, do it in a way where even if your trades go right, you do not lose a significant chunk of your capital. So a structured approach where the deployment is in a way where you are risking very, very little at a portfolio level. Out of 100 rupees portfolio, ideally we advise clients to have not more than 15 to 20% of their capital in options. And these are like very, very aggressive traders. But for conservative traders, we clearly say do not do options. This is not for you. But for aggressive traders, also we advise them to keep an upper limit of around 15-20% of their capital, because anything above that and you're literally playing with fire, and on one fine day when the view doesn't get right, you could literally end up losing a significant chunk of your capital.
So, can we say that the big boys are making money at the cost of the smaller ones?
Yeah, so you've hit the nail on the head. This is what is happening. You have the big guys who are sitting on one side of the spectrum with all the algos and the advanced systems to scalp even like mini profits or mini spreads that the market throws at you. And on the other side, you have a retail participant probably sitting maybe in his meeting, in a meeting room, a salaried guy, or a retailer sitting at his shop probably during the afternoon when there are not many customers. He's punching his trades through an app on a mobile platform. So there is a big difference between the kind of tools and mindset that these two guys are operating at. And what happens is you have a handful of these big guys on one side, and you have a huge number of retail participation on the other side, which is primarily long options. If you look at the institutional side, these are primarily option writers or sellers. So they have two things working in their favor. One is time, because they are selling options. And secondly, they are never selling naked options. So they're always using hedges. They're always using spreads in most of the cases. And on the other side, retail, because it is so sort of scared of the additional margins and don't necessarily do not understand the mechanics of spread trading or even hedging for that matter, they end up just buying plain vanilla options, and time works against their favor. And they're just hoping for that magical move in the underlying for them to make money. And most of the times, it is like 7 out of 10 times, the underlying doesn't move and they end up losing capital on the long options that they've bought. So unless or until the retail ups their game in terms of doing these strategies in a more sophisticated, in a more professional way, I think the story is going to be the same way, where the retail loses money and the big guys just keep on taking away a lot of money home. So definitely, it's like on one side you have a professional cricketer playing to the best of its limits. On the other side, you have a gully cricketer, and obviously you would know who would win the match at the end of the day. So a big gap in terms of skill sets and mindset both, as well as the resources available in case any firefighting or hedging is to be done. So it's definitely a very uneven sort of competition between the two of them.
So, in a way, our gully cricketers are playing professionals in an IPL match.
Absolutely, absolutely. And you should also ask that question, out of so many thousands and hundreds and thousands of gully cricketers, how many of them eventually make it to the IPL? Even that number is very, very small. So we highlight the guys who made it to the IPL, but those who didn't make it to the IPL is where the struggle is for the retail. So not discouraging anybody, but what I'm trying to say is whatever you are doing, do it with structure, do it with calculation. It has to be a calculated risk. Taking risk is fine, but don't be reckless.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Neil Ghai and sound designed by Rajas Naik. Do like, share, and subscribe if you like the episode. The Morning Brief drops every Tuesday to Friday on a listening platform of your choice. Keep listening and have a good remainder of the week. The clip used in this episode belongs to its owner. Credits are mentioned in the description.